Thanks very much for joining us. I'm joined here by Rob Shears, founder, principal director of Valor Private Wealth, and the founder of Safety First Investment Philosophy. Thanks for joining us, Rob.
Thanks very much, James.
So today we're going to give you a bit of an update on AI, and I'd like to sort of hand over to Rob to say a few words.
Welcome, everyone. Thank you very much for joining in on this webinar. Today, we're going to talk about one of the more important economic transitions, potentially in human history, and how that affects your wealth and your superannuation, and what we're doing to prepare for this economic transition.
And we're going to basically make a fireside chat. So I'm just going to ask Rob a few questions. Let me start with Rob, how do you see AI impacting employment over the next 2 to 5 years across both white and blue collar industries?
So that's a great question, and I think that there's been a lot of talk about AI being, taking jobs. And I'll just run through a couple of slides, and we'll just get to where we get to. Most importantly, this is the general advice warning. So this is general advice, not personal advice. So this is all just as a general nature. If you have any questions, please go see James or your advisor and ask them, and they can give you some personalised financial advice for your personal situation. So what's important is that AI is rapidly improving, and the AI of 2022 when it first came out is almost like the high school kid to the mathematics professor to what it is today. So AI is just past human capabilities in many areas, and that's what we're talking about here. And most importantly, it's the fact that AI is very likely to keep on getting better. So the AI of 2027 is where we're seeing things, really accelerating, and so we're preparing for AI being better than most humans over the coming years. So what we're constructing the portfolios for that, for what comes next, not for looking in the rearview mirror. And if you read a lot of commentary is talking about what happened last year, and that's not what we're talking about here. We're talking about what's coming in terms of AI improvements. So AI has just crossed the human capabilities for many white-collar roles, and that's going to accelerate, as you can see from that chart there. I do think that AI capabilities are going to keep on accelerating, but unfortunately, human capabilities are not accelerating. Therefore, the gap between AI and humans is going to accelerate. And the robots are only 2 to 5 years behind. So yes, the AI is what we're talking about here, white-collar jobs, but unfortunately, the robots are going to massively improve over the next 2 to 5 years as well. Wow. So, Mo Godot is an excellent former chief business officer at Google X, and he said this marks the first time in history that humanity is no longer the smartest being on the planet. So we are now the monkey to the human, and that's an absolute game changer. It's pretty scary. and that following on from that question you just asked is this slide here, and this is what it all comes down to: is that the human at $100,000 for a typical white collar role, 8 hours a day, 5 days a week. They've got sick days, they've got holidays, versus the AI, and the AI is getting better than most of these humans, but it's only $5,000, and it's already starting to be able to work longer than 8 hours now, and soon to be able to do well over 8-hour days, potentially working for almost days on end, and that's coming in the next 12 months.
So we're not just seeing white collar disruption, we're seeing blue collar disruption as well. That's what
so white collar is the first thing to start happening next year.
Yep.
But blue collar, I think, really starts to happen from about 2029 to 2032. So there is a delay on the blue collar side of things because the robots do take a while to build and they need to improve a bit more.
Yeah, interesting. I mean, if we do see meaningful changes in employment, what impact would that have on equity markets then?
So our view is that this is, sort of based off what like Dario Amodei said. And Dario Amodei said that we could get to 10 to 20% unemployment over the next 1 to 5 years. He's not the only person saying this. So Sam Altman's come out and said it in a different way, and so is Demis Hassabis, who's Sam Altman's head of OpenAI, which is ChatGPT, yeah. And Demis Hassabis is head of Google. Gemini. So we've got the three leading AI heads effectively. Dario Amodei heads Anthropic, and so we've got Anthropic, which is Claude. You might have heard of Claude. We've got OpenAI, which is Gemini, which is ChatGPT, and we've got Gemini, which is Google. All three of them are in different ways saying there's going to be a difficult transition. Just that Dario's come out and put a number on it now, which he may or may not be wrong, but he's sort of tied himself to that number. We think that there's a reasonable chance that Dario's putting a number to what everyone's really saying is probably close to correct, unfortunately.
Okay. And so do you see a bit of a flow-through effect on both residential and commercial property? Should this forecasting happen?
Yes. So we've built a three-stage view of what's about to happen. So for the next 6 to 18 months, the timing of this is not 100% certain. So for the next 6 to 18 months, we think that what's currently happening right now continues. So Iran, there's temporary shortages of minerals, and there's a lot of pent-up demand. So shortages and stagflation is the risk in the short term. So potentially higher interest rates, higher petrol prices, etc. But as we start to get to these job losses, we start to see rollover in deflationary pressures and significant potential deflationary pressures. That's when stock markets can go down. That's when property markets can go down, and quite significantly, depending on when we go into stage 3. Stage 3 is when the government starts to print money. And if they go into stage 3 fairly quickly, stage 2 could be quite short and sharp and we don't have major falls. But if the government takes too long to really start effectively taking over the economy, we need to potentially get to a point where the government is just paying people to survive.
And do you think governments are ready? Do you think they're aware of this? Or
the governments are aware, but unfortunately, governments have to be reactive. They can't preempt this. So the speed of stage 2 could be a little bit faster than most people are predicting. And as these models get much better than humans, then we could have a fairly quick deflationary force, and stock prices, house prices, and etc. Going down very quickly. It's the speed of the government being able to move, but also the amount of money they need to print is much larger than what they did in COVID. So this is a much bigger problem than what COVID was, because COVID was a temporary problem which had a sort of an end date, but it was a limited issue. This is a economy-wide issue.
Okay, so I mean, what's that mean for the Aussie dollar then? How will these phases sort of impact currency?
I think that in stage 1, we actually have a rising Aussie dollar because there's pressures on inflation, there's commodity price inflation, etc. So for the next 6 to 12 to 18 months, somewhere in that range, and as I said, the timing on this is not certain, we actually expect what's currently happening to continue. And then stage 2, we think that the Aussie could test the 2001 lows, which is 47.7 cents. So we could go below that because the amount of deflation is sort of unprecedented from stage 2.
Yep. So I guess in terms of the portfolio construction, what sort of investment strategies are best suited for each of these phases?
Great question, and this is where we've built this 3-stage process to try actually do reasonably well as much as we can in each phase. So phase 1 is sort of what's happening, but we've got much more cash and defensive than we usually would. We're keeping our defensive positioning very short-term defensive, not long-term defensive, for the next 6 to 12 months. We haven't sold our AI infrastructure, our chips, and our hyperscalers, and they're doing very well. So so we've still got TSMC. Google went up last night 7% after hours. So they've got Google Cloud growing at 63% per annum. So we're not selling the things making the AI or housing the AI. So the railways for the AI, etc. So that's still going to do well. We'll hold a smaller position in Aussie gold miners and a couple of other things. So that's the first stage, but we're predominantly in a lot of cash. But that cash is going to slowly be invested towards the end of this year, early next year, into longer duration government bonds, so longer bonds, so 10 to 30-year bonds. We might even buy some US dollar exposure, and we'll probably increase the Aussie gold miners. So that's stage 2, and we genuinely think that we can actually make money in a pretty difficult environment. Stage 2 could be a very difficult environment. It could be if we get to 10 to 20% unemployment. So the 10% was the GFC level of unemployment. If we get to Dario Amodei's 20% unemployment, that's double the level of unemployment to the GFC. So
big numbers.
So the GFC was 50% stock market falls, to put that in perspective. So we could have larger than 50% stock market falls. If we can buy these assets we're talking about in stage 2, longer duration bonds, US dollars, gold miners, they should go up predominantly during this stage 2, we could actually make money if we're correctly positioned.
Okay.
And then stage 3 is completely the opposite of stage 2, because we could go into significant inflation, potentially hyperinflation, but certainly very high inflation. Mm-hmm. And we want real assets. We want the world's best company with pricing power, so they can put their price up with inflation. If we do need to have clients who have defensive assets, it's got to be inflation-linked bonds and floating rate bonds, so you get paid more if the interest rates start rising.
Well, it sounds like you've got it covered there, Rob. Talking about sort of larger super funds, how are they positioned differently to something that Valor and Cashflow offer? Are there structural constraints at play?
Absolutely. So the big super funds have gone for one thing over the last 10 to 20 years, which is scale. So they keep on merging and getting bigger and bigger. And now a lot of these funds are $300 to $350 to $370 billion. And so scale has been an asset up until recently. But the problem with scale is you can't get out of positions, and so they're stuck. So whatever they have right now, if this all starts to happen in the next 6 to 12 months, they really can't have any meaningful change in their positioning, because they've got a lot of private assets which take a very long time to sell and quite illiquid. So the large super funds have almost got a noose around their neck in terms of their size is now an impediment to their ability to prepare for this.
They're essentially creating a monster.
Exactly.
Well, taking a step back, do you think investing is shifting from scale and size towards being sort of nimble and adaptive?
I think it has to be for what's coming. So this 3-stage process which we've built, the portfolio positioning for each phase, you need to be able to get in and out of these investments fairly quickly, because the difference between deflation, stock markets potentially doing a 10 to 20% unemployment, Dario Amodei, is potentially 50% GFC losses to 89% losses during the Great Depression. The Great Depression, the stock market went down 89%. Okay. So if we have GFC, 50% losses, potentially more than GFC to 89%. But the moving to stage 3 can happen within 24 hours. And so we need to be able to go from stage 2, and as soon as they start printing lots of money, we need to go to stage 3. And being able to move very, very quickly is one of our superpowers in this sort of environment. Okay. So we think that large, cumbersome, very slow moving, it's like trying to turn a massive ship in Sydney Harbour. It takes hours if you're stuck in Circular Quay. Yep. We're the little tiny boat which you can get in and out when we need to, and you really need to be nimble, I think, with what's coming, because AI, as we said, this is the first time in human history that we're going from being the human to the monkey. Yep. And things are changing very quickly.
Rob, that's very interesting stuff. Really appreciate your time for this webinar. I always value your time, and have a great day. Thanks for joining us.
Thanks very much. So, James, I just want to add a couple more points. So we've touched on AI, what we're doing, what we're preparing, but what we haven't said is that we're not infallible. No one knows that we're 100% right. So we could be wrong. But quite importantly is that we're thinking about where we could be wrong and trying to destroy our thesis. We have built a tracker to follow job losses to work out whether we're right or wrong. So we're running this in real time, following the job trackers, and this is looking at greenfield AI companies disrupting the incumbent companies. This is looking at job loss announcements from AI versus job gain announcements from AI companies, etc. So we're looking at this in real time, and we're very happy to be told, because there are a lot of people who are saying, oh no, AI is going to create lots of productivity, and all of a sudden that's going to create a productivity boom. But the problem is that this is not like previous times in history where it was, an extension to the human. This is just completely replacing humans. So we think that this is a different economic environment scenario.
Yep.
But the one of the most important things is that if we're wrong, the valuations at the current point in time, where we stand in terms of global, certainly US valuations, but certainly global valuations are elevated as well. If we're wrong, the stock market valuations are at or near all-time highs. Therefore, the expected future returns are quite anemic at best. Mm-hmm. So if we're wrong, we might actually be right because of valuations. Okay. So we have our AI thesis. But more importantly is that we're looking and we're quite intellectually honest with ourselves that we could be wrong. We could be wrong on this, but if we're wrong, you want to be in a fairly cautious positioning right now because of where we stand. And as you can see there from that chart, the markets are definitely elevated.
Yep.
There's not many guarantees in life. I can't guarantee what's going to happen in the stock market, but I can certainly tell you that this is not the lows of 2009 or 1982. So we're definitely not the lows, but far closer to the absolute highs, which suggests that you should be quite cautious anyway.
And I think everyone would agree with that. Any analyst you run into will say markets are high.
Yes, but very few people are actually preparing for that. So we're prepared for elevated markets, but also the economic AI transition. So if it's the valuations, which is actually correlated to these things, then we do better than most because we've been more cautious.
Okay. Yeah. I guess I will touch on one more point then. If AI is improving data analysis, why does human judgment still matter in investing?
Very good question. So AI is very good at looking at a narrow focus on things, but when there's far more than 5 or 10 inputs into something, you need to have human judgment and intuition, and that. At the moment, AI can't do that, and I think that AI will struggle to do that because humans have the ability to use their subconscious mind. Obviously, our conscious mind can only think of 7 things at one point in time, so we're limited as well, but our subconscious mind is unbelievably powerful, whereas the AI subconscious mind is limited at the moment to a token window, which is not able to think as broadly as humans at this current point in time. At some point in time, if we get to AGI, maybe that changes, but certainly at least for the next 5 years, I think that human judgment is, particularly for investment management, we can think of 1,000 scenarios and weight which one's more important far better than AI can at the moment, because we can use subconscious AI and understand the most important things.
Brilliant. Very interesting, Rob. Rob, how do you actually protect client portfolios when markets fall?
So we're investing on a multi-strategy approach to do this. So if we look at the 4 areas which we think will protect on the way down, we quite strongly think that stage 2 is deflationary. So if we go back to the slideshow there and we look at stage 2, the deflationary environment, if it's deflationary and they lower interest rates, then government bonds can go up in value. If someone has a 5% government bond and someone else has a 1% government bond, the 5% government bond goes up in value till it gets to 1%. So you make money on longer term government bonds.
Okay.
So government bonds is number one. The Aussie dollar potentially going down quite significantly. If we have overseas assets, we can make money on a falling currency, or protect from our overseas assets. So we might have some of those overseas assets, share market going down, but the Aussie dollar could go down equal or a greater amount potentially. So there's that. We think the gold price will go up, but we think the gold miners will do better than the gold price because the gold miners get a triple tailwind. They get the rising gold price, the falling currency, which means in Aussie dollars, the gold price doesn't just go up in US dollars, it goes up again in Aussie dollars. Yep. And we also get the lower wage pressure, which is currently a problem for the gold companies. So they actually have potentially lower wage costs. They get triple tailwinds, so margin expansion from 3 different areas. And the fourth one is so we have a couple of other positions which have a similar thing to gold, which are they get margin expansion from having overseas revenues, so US dollar predominantly revenues, and Australian dollar costs. So if the Australian dollar corrects, it's part of the Australian dollar thesis, but the companies should go up significant margin expansion and a lot more than just the Aussie dollar going down. If the Aussie dollar goes down 50%, you can make 50% on a lot of these companies. If you can increase your profits by 2 or 3 times, you actually make a lot more money from the margin expansion from the falling dollar.
Yep. And what drives your investment decisions? What do you deliberately avoid?
So we're certainly looking at things which, because we think that if we do get to Dario Amodei's forecast of 10 to 20% unemployment, then the demand destruction and someone's job is someone else's spending. So someone's job is someone's spending, which is someone else's job. Sorry. So if someone has a job and they stop spending at David Jones, then David Jones starts to reduce employment. So someone's spending is someone else's job.
Yep.
So demand destruction could be quite significant. So we're trying to avoid almost everything with consumer-based dependency. Financial-based dependency is often a lot of the problems because there's quite a bit of leverage in the global economy. We've got some of the highest global debts in history, going into potentially one of the largest deflation events in history. So those two are not correlated, but the financial system is not designed for deflation. So the financial system with significant debts. If you have, and there's quite a few of these larger super funds have 50 to 80% leverage in some of their office property. If they have 80% leverage, that means you only need to lose 20% on the value of the office before you run out of 100% of your equity. That then becomes a solvency issue if they can't pay their debts. So we have financial areas where we're trying to avoid, and just generally speaking, we're also looking to try and avoid marginal companies and companies don't have pricing power and companies who have any debt.
Interesting. And how do you know when a portfolio needs to change? And what tells you it's time to act? What tells you one of these cycles has hit?
Good question. I think a lot of people will wait until the job numbers come out and say, okay, we're now at 10% unemployment. That's too late. I think the markets are forward-looking. So if you look at the stock market, I think there's somewhere between a 12 to 18 month forward-looking scope on the stock market. So if they see job losses trickling up, but then they see it likely to accelerate because they understand that AI is going to not stop, AI is not going to stop getting better, then the market will react before the job losses actually get to Dario's actual 10 to 20% unemployment. It might take 5 years to get Dario's 10 to 20% unemployment, but the stock market might have dropped well before that actually happens. So yes, it might take 5 years, but the stock market might bottom after 2.5 years. So we think that waiting for the data to come out might be too late. That's why we have our own bespoke in-house job tracker to look at leading indicators, not forward indicators. We're keeping that data fairly quiet to ourselves. We don't want that's our own IP, and we don't want everyone else to copy exactly what we're doing. So we should be able to see it because we're looking at this from 6 different angles. So we should be able to see this in one of the different areas we're looking at, sort of potentially 6 weeks to maybe 3 months before everyone else does.
And that will give you time to react and adjust
the portfolio. I mean, we've already reacted and adjusted the portfolio. So we think that the probability of this coming over the next 2 to 5 years is very high. So there's no point in sitting around because if we sit around thinking this starts in 12 months' time, but in that same period, oil prices go up to $180 a barrel because the Strait of Hormuz is blocked, then the stock markets go down before you get a chance to get out. So the reason we got out before we think it actually starts, we think this starts probably in 6 to 12 months. Not now. The job losses haven't actually started in earnest yet. Yes, there's been a couple of announcements, but we're talking about the big start of this is probably later this year, but to the beginning of next year.
In the near future, basically.
Yeah, correct.
And I mean, if your strategy is not working as expected, what does accountability look like? What do you do to adjust it?
Yeah, so if we're wrong and we see that this is not going to cause and it's causing the productivity boom, which is probably the scenario where we're wrong, because if the scenarios we're wrong is if we're slightly wrong, it still increases unemployment somewhat. And that still causes a mild recession, and that still causes the stock market to go down. We're still somewhat correct. Where we could be,
win tells you win.
Yeah, well, yeah. So the scenario where we could be wrong is this does cause a productivity boom and very slight job losses, but all of a sudden we start to see everyone starting to create new jobs. And that's very difficult to see if that's going to happen. We do think that that's not likely because we think the new jobs will be a jobless boom. So if you're starting up an AI greenfield company today, you don't go out and employ 100 people, you get 10 people and you use AI for the other 90. So these new companies are far more efficient in terms of the number of people they're employing, and they're just not employing lots of people. They're using AI instead, AI agents instead of people. Okay. So we don't think that's likely, but if we do see AI causing a boom, we're happy to reinvest back into markets if we realise that's the scenario. But we need to see strong evidence that there's a hiring boom and actually potentially job shortages because it's creating more jobs than it's losing.
Very interesting. Final one, bit of a fun one. So if I ask AI the same questions, is it going to give me the same response?
No. So the secret to using AI is you need to get it to ask you potentially 100 questions to get it to understand the context of what you're trying to get to, because AI tries to answer questions quickly and use as few tokens as possible. The reason why a lot of people are getting bad answers and getting a lot of misinformation out of AI is because they're not using it correctly. You need to make sure the AI is using only official data sources. You need to make sure it doesn't read some opinion by someone who's just
On
written
Reddit?
on Reddit. It's actually using a lot of Reddit, actually, which is that's where it trained a lot of these things. So you can't let a Reddit thread pollute your thinking. So you need to make sure that you're training the AI how to think, what to think, and then get it to ask you the questions, but usually 100 questions before you can answer one question. Okay. So you can't just go and ask these questions to AI. You need to say, well, this is the context. I want to know what's going to happen to stock markets, and you need to work through multiple scenario analysis for it to understand. Otherwise, it'll just use whatever forecasts are out there by everyone else. But if the forecasts out there by everyone else are using the wrong inputs, then you're getting the wrong outputs as well.
Very interesting. I use a Facebook post, for instance.
Yes, exactly.
Rob, again, thanks for joining us.
Thanks very much.
Little snip. And this is Meehan and Rob Shears signing off.
Thank you very much.